Tell me a bit about Bitcoin fair value. I know you didn't want to share the sort of the proprietary stuff. Fine, of course. Tell me where it is. Maybe give me some comparisons. Why should we be looking at this now? Why is it important?
Yeah, absolutely. So Bitcoin fair value, it is proprietary, but I did open source the equation. So it's an unweighted version of the equation that people can see. Actually, if you go to the Bitcoin fair value Twitter and you just click the hyperlink in there, which is the ciadc.co/BFV, people can go read the report there. People can go read the report and see it with their own eyes, because I published that before the last halving, because everybody was asking me, what happens during the halving? How does it affect prices? How does it affect miners? What's going to happen to hash rate? What's going to happen to difficulty? A plethora of questions. And that algorithm is designed as my management system. And it's very simple. You'll see one of my most recent tweets. I said, Bitcoin fair value, price just broke out to Bitcoin fair value, just with this recent move up to 44. It's only the fourth time in 7 years that signal's been sent. So, talk about having the right time frame and the right mindset. A lot of that stuff out there is like buy, sell, buy, sell, buy. It's like that is like the worst strategy. Like if you trade, you're going to lose. But if you have a long-term cyclical strategy based, so a long-term cyclical strategy, actually just go to my page real quick, because this will really help people visualize what I'm talking about. You just go down, you'll see the chart. It's got a big red cloud on it. Keep going. Right there.
There we go. Yeah.
That's the one. Yeah. Blow that chart up, because this was visualizing. This
is CJ's Twitter. This tweet's from I think like earlier this week, right? 2 days ago, something like that.
Yeah, not long ago at all.
The 5th, yesterday. Yeah.
So what you see here is the red cloud is the cost of production cloud. The bottom of the cloud is the electrical cost, an electric cost only. The top of the cloud is the all-in cost. So the bottom of the cloud is basically OPEX. The top of the cloud is basically OPEX plus CAPEX. So what happens is you have to have, as an investor, you have to be able to answer the question, is what I'm buying cheap or expensive? And when it comes to Bitcoin, the best way to answer that question is taking the market price and relating it to the cost of production price, right? So Bitcoin fair value is not attempting to say this is what the price of Bitcoin should be. That would actually be a pretty stupid algorithm. Like no algorithm could do that. And if it could, you'd be quiet about it because you could make billions. So that's not what this is about. This is about creating a baseline. And the baseline is based on the cost of production. And a lot of people say, well, that's the labor theory of value. No, it's not. It's business 101. Because if you believe in the value proposition of a product or a service, you must pay above the cost in order for that business to continue to offer that product or service. And if you don't want to pay above the cost, then that means that the product or service is not delivering value. Therefore, that's the free market price signaling to the producer, stop wasting your resources. Produce something of more value, of greater value that can bring in a profit, because people are willing to pay above the cost. If people aren't willing to pay above the cost, that's the market signaling to you that what you're doing doesn't deliver enough value. Redirect resources. So with Bitcoin, you'll see this is 7 years going back to the 2016 halving there on the 9th of July. This typically only happens 2 times. So a lot of people ask me, they're like, CJ, how do you what's your strategy? How do you do this? My strategy is let Bitcoin do the hard work and just answer the question. Is it cheap or is it expensive? And when you'll see, when price breaks out from the red cloud, which typically happens only 2 times per cycle, and fancy enough, we just got our second time from this most recent cycle. Now, the reason it happens close after the halving is because what the halving does is it doubles the cost of production for the miners. Overnight, without mercy, the cost of production doubles. So it's kind of hard to see in 2016, but in 2020, you can see that cloud double overnight. And it puts the price right back in the cost of production cloud. And within 3 to 6 months, price will break out of the cost of production cloud. And that's when you go to new all-time highs. But when you look back to after the 2018 bear market, where we went back into the price cloud, by the way, when the price goes back into the price cloud, that is when you buy, right? So this cycle is probably going to be my last cycle as a miner. So if anybody is out there and they need somebody for treasury management, you can feel free to hit me up. I'll come and consult with you, because I'm out of the game. I think hash rate is going parabolic, and I don't think it's going to be. I think you're going to need institutional resources to continue to compete. So this is my last cycle, but I'd be happy to come help you refine your treasury management system, because instead of issuing debt, instead of raising, becoming a public company, this is what miners need to do. When price is at a premium, you sell what you're producing and you build a cash position. So you saw that after the 2016 halving, price went to a premium. Well, every single day that miner should be selling and building a huge pile of cash in anticipation of deploying that cash once price goes back into the red price cloud. And that is how a miner can actually, without losing cash flow, build a Bitcoin equity position on their balance sheet, right? Because it's a confusing question. Does a miner mine the Bitcoin and then just hold the Bitcoin? But if you hold the Bitcoin, you can't get the cash flow. You can't settle your debts. So the best way to do this is to collect the cash, build up a big cash position during the premium phase when price is above the cloud. And then when price goes back into the cloud, you don't just mine with your hash rate, you mine with that cash position. And the difference, the profit, the difference made in that, once price comes back up, turns into how you build your real Bitcoin position. So not only can you earn Bitcoin and mine Bitcoin, but you can also build a Bitcoin position on your balance sheet. Well, what's good for miners is actually good for people like you and me too. Because if you use this same strategy and you say, okay, when price is in the red cloud, I'm going to buy, and I'm going to buy like there's no tomorrow. And when price goes above the red cloud, you don't necessarily have to sell, but you definitely stop buying, right? You let your cash flows build up during that time. You don't have the dollar cost average in during that time. You see a lot of people. I love Wicked S Bitcoin has a sick chart about if you dollar cost average in from 70,000, even till today, you're up 50%. But if you dollar cost average in when you were in the red price crowd, you're up like 150%.
You guys are saying the same things. It's just that you've narrowed it down and really quantified, CJ, where the sweet spots are, right? This is a great strategy. And actually, to your point about treasury management for miners, my co-host Len and I have disagreed over the years about whether miners should hold or sell Bitcoin. I have always been in the case that they should be selling, because if you don't sell when times are good, you will be a forced seller 100% of the time. Period. End of story. This is so much tighter an explanation as to why. And I'm surprised that more people don't understand this. Surely people have asked you, like, how did, where, if you back tested this with like some of the miners specific, like the way they've handled balance sheets, the way they've brought in Bitcoin through their mining revenues, or is this just a steady, this is going to work no matter what, because of the way you build up your cash during the good times and use it during the bad times?
Yeah. So really the only reason I've went this much in depth is because this is my last cycle using it, and miners are very competitive. So I doubt anybody is going to, care about this. They have their own strategy and they're right and you're wrong. And that's kind of the mindset you need to actually be successful. But for people who really want to optimize their treasury management, there shouldn't be humans making a decision. It should be algorithmic. And that's what Bitcoin Fair Value does. It makes treasury management algorithmic. It removes the human element, right? Bitcoin removes the human element from policy. Well, Bitcoin Fair Value is an algorithm that removes the human element from treasury management. And it boils it down to the most important question, which is it cheap or is it expensive? And this is a basic commodity cycle, by the way. This is true to every single commodity in the world. There's no difference for Bitcoin. The only difference for Bitcoin is, look at the bottom red line. Notice that bottom red line is going up. There is no other commodity in the world where its cost can be increased by the commodity itself. The difficulty adjustment as hash rate grows and the difficulty increases, right? Price drives hash rate drives difficulty drives costs. So yes, it's very fun to talk about the 20,000 peak and then the 14,000 through the expansion phase going into the halving, and then the 70,000 peak and the expansion phase we're going into now before the halving, in anticipation of that doubling of cost to get the price to where it needs to be to maintain profitability. It's very fun to talk about the tops, but what's more important are the bottoms. And Bitcoin is the only commodity in the world that can raise its price floor, because as in any other commodity, as the premiums grow, the supply expands. Bitcoin supply can't expand. And then a lot of other commodities, you know, Jeff Booth is really good at pointing this out. There's technological deflation. So the technology is making you more efficient and the cost of production actually goes down. But for Bitcoin, the cost of production goes up. It was engineered. It was strategically designed to leverage the natural laws of economics, commodity cycles, and price discovery to empower we the people. And this algorithm is based on that understanding of Bitcoin's engineering, and you can't beat it. I mean, it's a very simple process. Like right now, it's a lot of fun, but if you're a miner, you know, it's time to start locking in profits. And it makes sense because guess what? You need to raise funds for your OPEX after the halving. Your margins are going to get slashed 50%. You're going to get crushed in just a couple of months. So you better be raising cash right now to carry you through that 3 to 6 month period after the halving before we get a new all-time high price discovery. And one last thing I'll say is if people go on and they read that BFV report, I give you an example. I give you an exact mathematical example. I fill out the equation with the real world numbers back on May 5th, 2020, when I published that report. And I show you what happens after the halving. So you can see how each variable changes after the halving and why the halving is actually the catalyst to a new price discovery cycle, because it's based on the new cost structure economics of Bitcoin, the only asset in the world that can raise its own floor price.